APAC, time now for a rare television appearance. Mohammed Apabhai, head of Asia Pacific Trading Strategies Group at Citi, among the foremost voices on global market trends, is joining us now. Good morning, Mohammed. Thank you very much for joining us. It's been almost 14 months since we saw you. Sonia was just telling us that you spoke to us on the last budget day, and of course that triggered an unprecedented rally in Indian stocks. But where are we now? We have seen a big rally in Indian markets from budget in 2017, but in 2016 as well. Would you worry about valuations now? Are you still buying India?
Well, thank you very much, first of all, for having me here, and good morning to you as well. I hadn't realized it's been so long since I've been last here, and I apologize for that. I think where we are right now is that the markets are still very much being driven by global liquidity, and that liquidity is appearing in all across the region. We've got an indicator that we look at quite closely. It's the central bank balance sheet indicator, which looks at the aggregate level of global central bank balance sheets across the world. And what is happening is that that indicator has actually hit a record high today. And what that is doing is it's pumping this money right across the region. What we're seeing is the money going not only into equities and emerging market equities as well, but also into credit, commodity and bond markets as well. So for the time being, we think that this is a liquidity party. I think investors should continue to enjoy it. It's a bit too early to take money off the table. We do see some problems in the next 3 or 4 months, but at least for the next month or two, maybe until late April, early May, it's probably worth just sticking the course. And of course, when we get such a strong liquidity inflow coming into the region, then you are going to get into a region where you get the valuations at pretty extreme places. So there are investors who are concerned out there, but it does seem like the liquidity is just forcing them out of the market every time they try to fight against it.
Okay. Mohammed, good morning. You have seen a lot of market cycles, and tell us the kind of fund flow situation that we have right now. Are we more closer to the 2000 to 2003 phase, or more closer to the 2008 phase from emerging market point of view for the larger picture?
Yeah, I think from an emerging markets point of view, we're nowhere near the 2008 phase where equities go into a bubble and we sort of see the parabolic behavior. The valuations are just far too cheap for that to be happening. Maybe not in certain markets, maybe not in India, for example. But even in India, we are not at extreme levels of valuation. Now, I think that if we rally, what we thought was going to happen was a few weeks ago, I think early February, we sent out a note to our investors saying that we thought the markets were at this crucial inflection point, that either the markets were going to turn down or there was going to be a very quick move up. And actually what we saw was the fastest 100-point move up ever in the S&P after that call for an inflection point higher. Now, we think what is going to happen is that within another 4 or 5% of where we are right now, so let's say in the US equity market, maybe another 4% above where we are right now, there is another point at which the market is going to have to decide whether it wants to go into a bubble or not. So from that perspective, where we are at the moment is probably not completely dissimilar to what we saw in 2013, where we had a lot of liquidity that was coming in as a result of various QE programs from the different central banks. Remember, at that time, it was bond yields that actually punctured the euphoria in May 2013. This time round, I think if we get to bond yields around 2.75% on the US 10-year, it'll probably be a little bit more problematic for emerging markets. We'd be looking quite closely at that as well. But at the moment, at least in the immediate short term, we're not seeing any of that at all.
Mohammed, hi, good morning. I'm going to come back to that correlation between the global markets and emerging markets. But before that, I wanted your view on, particularly on India. What is the sentiment amongst large FII investors and traders that you've spoken to with respect to India now? Are big funds putting in chunks of money to work in the Indian markets?
It's interesting because I was in Europe about 2 or 3 weeks ago, and we probably spoke to about 60 or 70 investors over that time. And we had discussions from Japan to China to Korea and Taiwan and various other places across the region. And India never came up even once. So it does seem that India was a bit off the radar for foreign investors. Now, I think the investors were waiting for the outcome of the election. And what we've seen is, even in the last week, we've been drawing the parallels between markets like Korea, where we've had the impeachment of the president. A new president is now going to come in probably on May the 9th. And the breakout that we saw in the equity market there triggered a chase for a couple of days. And it seems like there's still some more upside to go. And then you compare that to India as well, where what we've seen is we've seen the positive result, at least from the market's perspective, of the state elections, a breakout above 9,000, and then people are really sitting there wondering whether they should be chasing or not. So I think at the moment what we are seeing is this wave of money that is coming in across the region. I think the one that is catching most people off guard is actually not in India. I think they still have exposure to India. The one market that they are very underweight in is probably in Hong Kong and China. And that is very much driven by credit markets. Now, the other thing that your investors might be, or your audience might be interested in looking at, is really this correlation that is built up since the US election in November 2016 between the Indian equity market and China credit. Now, China credit has actually been driving most of North Asia, but what has been very interesting is that India now seems to have joined that camp, and so that correlation seems to have increased, whereas in the developed markets, the correlation is very much to US 10-year bond yields. So what you've seen in the last few weeks is that US 10-year bond yields have been going up, and they seem to have stalled, and those equity markets in DM, in the developed markets, have stalled as well. But China CDS continues to tighten, and we're actually thinking that credit is now looking very expensive relative to equity. But again, the liquidity continues to flow in, and until that liquidity stops, it's going to be too early to fight this market.
Okay, in that case, Mohammed, can you give your pecking order in emerging markets?
In emerging, I think it's actually quite difficult in terms of trying to decide where the market is going to allocate the capital. I mean, the way that we've been watching it is that basically there is this fairground game of whack-a-mole, where you basically have the mole appearing on one of the holes, and then you whack it down, and basically it appears somewhere else. So what we've seen is really liquidity coming into Taiwan. From Taiwan, it went into China. From there, the leadership picked up in Korea. The last few days, we've seen it going into India. We've seen it going into Brazil. So it's sort of, I think it's going to be quite a high correlation. And I think what is happening is that people are looking for the underperforming markets and rotating back into those as well. Now, going forward, I think the picture is not one of unconstrained bullishness. I think one of the things that we're looking at, for example, is that the whole of this rally from the US election has been driven very much by hopes of reflation coming from or emanating from the US and from President Trump, but also coming from China. So you've probably seen the recent PPI data that has been coming out from China, and people are hoping that what that means is that the Chinese credit problems will actually heal. Now, if you believe that, there's going to be very, very significant upside in the Chinese equity markets. And we're talking, you know, some of the numbers that we've done indicate that if the financials can eliminate this credit problem that they have, you could be looking at 60 to 70% return fairly quickly in China. And we saw that, for example, in 2015. Unfortunately, we're not believers of that scenario. And one of the things that concerns us is that some of the things that we're looking at in terms of forward indicators are indicating that China PPI and therefore US CPI as well could actually turn lower by the end of the year. And if that happens, then that's going to be very much a realization like what happened in 2011, 2012, 2013, where the market got ahead of itself in terms of the reflation argument and actually finds that they get disappointed. But that's going to be a story, I think, for the late second quarter, maybe early third quarter, as we find out exactly whether this reflation hypothesis actually plays itself out or not.
Back, we've been speaking with Mohammed Apabhai, head of Asia Pacific Trading Strategies Group at Citi. Mohammed, you began by telling us that there is a huge liquidity rally which investors should enjoy. But in your last answer, you raised one red flag in the second half in terms of Chinese PPI and the Chinese financial sector. What and when are the red flags you would watch out for in this liquidity rally?
I think there's actually a number of red flags that are probably going to come up, and I want to emphasize that these are not things that are going to happen in the immediate short term. These are more for the post-May, June sort of time frame. I think over that time frame, what we're going to see, for example, are things like the hypothesis that we've had is one of reflation. Now, the other thing that the equity markets are looking at is, especially in the US, is tax cuts. Now, one very simple way of looking at this, and it's obviously a very, very simplistic way of looking at it, is if you look at US equities where they bottomed on November the 9th, it was somewhere around 2030, and then if you assume that 1% tax cut is effectively 1% on the S&P, then if Mr. Trump is going to cut taxes by 20%, and that gives you a target of somewhere around 2460, 2470 on the S&P as to where to go. Now, if you get to the middle of June and you find that the tax cuts are either delayed or they're not going to happen in the way that the market thinks, or they're not as large as what the market expects, then of course that's going to be coming back. I think another thing that you need to look at is really what happens with earnings. So, for example, in the US, the earnings are already being scaled back for the second quarter. If that continues, then that will be giving markets another room to pause. I think yet another factor, we're expecting the Chinese renminbi to continue its devaluation, or to resume its devaluation. It's been pretty stable since the beginning of this year, despite market expectations that the renminbi would continue to devalue. That hasn't happened, but we think that's going to start again probably at the end of the last week of March and then continue feeding through. Now, if that also coincides with the time when the when the PBOC and the Chinese authorities crack down on commodity speculation, that will actually be very negative. I was looking at, just before I came here, the forward curves on the commodity prices on things like iron ore and steel bars, and basically December contract is about 20% below where we are in terms of the spot futures contracts. So again, that would be a disinflationary force. Now, again, we haven't seen any action from Mr. Trump on tariffs or anything that would cause the dollar to rally. So there are a lot of things that potentially could be negative, but above it all, if there is something in terms of the market considering that the liquidity that may be coming from the Fed, the ECB, the BOJ, or if there's a big outflow from PBOC reserves, then those would be very negative. I can give you a lot of reasons why you want to be bearish right now, but I just don't think it's the time to be positioning for it right now.
Yeah, that caution is always taken on board, Mohammed. But these could be, of course, outliers, and we'll deal with them when they play out. You said that India has been off the radar of foreign investors, and we saw that in numbers all through the last quarter of last year in particular. Now that we have started to see some inflows into our market, do you get a sense that we could go through a foreign investor capitulation if the momentum picks up in our market, and we could see a lot of ETF inflows into Indian markets?
Yeah, I think it's very possible. I think what we're seeing at the moment is the first stage of that is the allocation of capital through emerging market ETFs. And even in the last couple of days, we've actually seen the emerging market inflows coming in. Today might be a little bit of an aberration. There is a big FTSE rebalance that is happening right across the region. That will see net outflows coming out of markets like China, Japan, Taiwan as well. But I think the flow is definitely coming in. We've seen an outperformance of emerging markets so far this year. It's about 7%. Now, to put that into context, over the last 5 years, emerging markets have underperformed developed markets by something like 70%, so 70%. We don't think that's going to reverse, but at least this is the time when the market becomes a little bit more hopeful. And we still think that there's some upside in the Indian markets, maybe 95, 75, 9600, and it may happen within the next 4 to 6 weeks even.
Oh, that's interesting. The last time you spoke with us, you said that the quality of this rally was low and you were not too happy with that. This time around, are things different? Has the quality improved, or is it purely a liquidity-driven rally and not something based on economics and growth?
Well, I think it's very much based on the hope of economic growth and the hope of reflation. And of course, equities rally on the basis of hope. It's sort of one of the reasons why people like me appear on television to talk about these sorts of things. But I think the thing is really that if this reflation does happen, then we haven't even started to see the moves yet in the bond market to reprice that. And of course, that will mean very significant sector and country allocations. Of course, if the reflation doesn't happen, then everything that we've seen happening over the last 3 or 4 months will actually go into reverse. And one of the things that is very interesting is that emerging markets actually, you can paint a scenario where if we stay in this 230 to 260 trading range, it will be the ideal environment with the dollar relatively weak. What is very interesting at the moment is that if we're looking at markets like Korea and Taiwan, what is happening is that the leadership is with very few stocks. So it's with things like Samsung Electronics, Hynix, a few names, TSMC, Honhai. These names are leading the market up. Even in India, if we look at what's been moving the market higher, it's really been things like Reliance Industries, as far as I can tell, and some of these under-owned names. Now, I think that from that perspective, what is happening is that the headline index level is going up. What we need to look at, I think, from here on in for the next leg of the rally is really stocks that are going to deliver some quality earnings. Now, of course, whether you should be in cyclicals or in defensives really depends on your view on reflation. If you do believe that reflation is happening, then you do want to be in those cyclical sectors, which are still quite under-owned despite the repositioning that we've had. But unfortunately, if the reflation doesn't happen, potentially you could get the next leg of the bond market move down, could see US 10-year bond yields down as low as 1% if that reflation doesn't actually occur. So really that is the big call that investors need to make when they're having a look through their portfolios. Really that is the question that you need to answer, is whether they're on the reflation camp or whether they think that the disinflation that has been haunting markets for the last 8 years will actually return.
Okay, Mohammed, we will have to leave it at that. Out of time. Thank you very much for dropping by, and we do hope you will drop by oftener.